Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Thanks, hi Julieta.
And we shall start talking about the S&P 500 as we always do. And there's a lot of noise, particularly in US markets at the moment. Trade wars, Google, Huawei, it's a mess.
Yeah, it is a mess at the moment, and the markets have sort of shown a little bit of discontent recently with all of these developments. If you look at the chart of the S&P 500 here, what's particularly notable is that it's traded down to the 2800 level recently. We did cite that on last week's show and said that what was quite possible was that it maybe bounced up. There was a gap in the chart there which filled in at the underside of the 50-day moving average, and I said that it was possible that it likely goes and closes that gap, tests the underside of the 50-day moving average, and then we would have to see from there whether or not it begins to form the right shoulder of a head and shoulders pattern. Now, so far, if you look at that, there's clear evidence of selling at the underside of the 50-day moving average there over the last couple of days. That's indicated by those long tails to the upside on the daily candlestick patterns. So what it does look as if it may be happening now is we might start to see the right shoulder of this head and shoulders pattern begin to form. The neckline, of course, will come in at 2800, and that's what we really need to watch very, very closely in the days and weeks ahead. Okay. If you start to see this market breaking down below 2800, then your first stop then would probably be down at 2750, which was that swing low that we saw in early March. Also note you've got your 200-day moving average over there, which comes in at around about 2775, thereabouts. So that also would possibly be an area that might attract a little bit of buying. But if the head and shoulders pattern validates properly and it trades all the way to its target, then the target actually comes in down all the way down here at 2650. So that's the lay of the land as I see it at the moment. Obviously, we know that there's a lot of uncertainty. The markets are concerned about the trade war situation, which seems to be becoming more and more complex. So we'll have to see. I think for my money at the moment, I think a best case scenario is probably that we're going to muddle along and chop around sideways for a while. But if that's not the case, if we do get a sort of a more bearish type of scenario, then that head and shoulders pattern validates, and we could actually see a deeper pullback towards the 2650 area.
Is it a given that the local market would follow suit? Or alternatively, might you have people pulling money out of US markets, saying, okay, well, there's value in emerging markets. South Africa's pretty cheap. We'll put our money there. Or would we just get caught up in a sell-off?
Usually we just get caught up in the noise. You know, there's that old saying that if the US sneezes, the rest of the world catches a cold. And I think that's relatively true, particularly when it comes to our market. You know, we are not immune to what happens out there. And usually when you see a risk-off type of environment led by the US, it's very much likely to follow through to the other markets around the world. Okay. And emerging markets actually sometimes come off a bit worse in a risk-off environment. So I certainly don't see it where they would suddenly get excited about South Africa because the US is a bit concerning. In terms of our market, this is our top 40 spot index on the JSE. And like I said last week on the show, we've been going on and on about this upward sloping channel since the beginning of the year. But that was broken to the downside recently, and it also coincided with a break below the 50-day moving average there, which you can see quite clearly. That was now the first time this year that the market has actually traded below the 50-day moving average since the beginning of January. So that's quite a meaningful technical development. And the market has remained fairly weak since breaking down below the bottom of that channel. Now, the big technical level that we need to monitor here now is 49,000. That is a lateral support level that you can see over there. That joins those low points from the middle of March and again the recent low that we saw in early May now. So that 49,000 level is critical. And again, one does wonder whether it bounces a bit here but then starts to maybe form the right shoulder of a head and shoulders. It'll remain to be seen whether or not that is indeed the case. But I think from a technical level to monitor, 49,000 really is a key level, and we've got to watch that in the days and weeks ahead.
Yeah, it'd be very unfortunate because we've pulled back quite significantly. I mean, and a lot of people were hoping that this year would be a convincing break with our past, would make 10 to 15%, but now we're starting to hand everything back. So
yeah, I mean, we're down, nearly 4,000 points from our recent high. And obviously that's now giving back some of what has really been a very strong start to the year, because you can see since January, really, that's the beginning of January there, the market was pretty much straight upwards. But it's not unexpected to think that it would give back something. And also in my experience, the middle of the year time frame actually often is a bit choppy and a bit bumpy. So it's not out of character really for the markets, but of course we do also have this added extra risk from the trade wars in the US and so on that is
Yeah.
creating a bit of uncertainty globally.
Okay, so let's look at some recent trades. Cap Industrial was a stock in which had gone long, but then it sort of just fizzled out, really.
Yeah.
I mean, this one ended with a whimper, not a bang.
Yeah, that's quite right. It's been frustrating. So we've got out of it now, and thankfully, because it's been rather tedious to keep holding this. So why we got into the trade, first and foremost, you can see that big gap to the downside there in late March. And what that was caused by was when Steinhoff announced that they would be doing an accelerated book build, whereby Steinhoff was selling their remaining stake in Cap Industrial in order to try and bolster Steinhoff's ever shrinking balance sheet. And as a result of that, whenever you see an accelerated book build, typically it's done at a discounted price. And this is exactly the case here. You saw the price gapping down quite sharply. A massive slug of shares were exchanged at a big discount to the prevailing trading price beforehand. And then usually what you will get is a situation where that stock is snapped up, which it was in this case. It was snapped up quite quickly. But and usually you'll get a recovery to go and fill the gap and possibly more. Now, in this case, that's exactly what we were looking for. We went long of 13,000 CFDs at R7.02. I was looking for a move to R7.40 to target that gap close. Now, we did actually get the R7.40 target, but at the time, we had just had the elections, and I thought, let's just give this a little bit of time, because if we see some positivity coming through for the domestic stocks following the elections, then CAP would potentially be one of the beneficiaries of that. And unfortunately, that hasn't really played out with any of the domestic stocks, actually. It's all been a rather disappointing follow-on from the elections, actually. None of the expected optimism in the domestic space has really materialized. In fact, a lot of it happened before the election, and that has fizzled out after the election. In any case, I said previously that we would move the stop loss up on this CAP trade to R7.20, which is all those lows that we saw over the last couple of weeks. And if it broke below that R7.20 level, then we would look to cut that trade. So that has happened now. So I've closed it out at R7.20. It means that we made a profit of R2,182. So, it's something, but it's, as you say, it's a whimper rather than a bang. But I am quite glad to be able to just put this in the rear view mirror now, because it's been rather tiresome to watch that thing just grinding along sideways and not really making any meaningful progress for a number of weeks.
Yeah. And what about Google? I mean, Google started off so well. It was looking fantastic. You did take profits on half of the trade, and then it just collapsed.
Yeah, I did. So let's just quickly, this is now wrapping up a trade that has been in the making for nearly 2 months, actually. Now, what we initially did was in late March, we saw that falling wedge pattern on Google. When it's a classic falling wedge in a bullish rising trend. Usually that is what we refer to as a continuation pattern, and usually they will break to the upside and continue the upward trend that was intact prior to the wedge forming. So that's exactly what happened. We went long of 10 CFDs at $1,183 per share, used a stop loss at 1,160, which meant it basically below the bottom of those candles at the bottom of that wedge pattern there. And I said I was looking for a target to 1,230 initially, which essentially was a retest of the previous high. That's usually what you would get as a minimum target from a falling wedge pattern like this. So it got to that target. I banked profits on half of it at 1,230, which meant we made $233 on that part of the trade. I then said, let's try and run the rest of it and see whether we can't get more out of the trade. And for a while, that looked like a super strategy. You can see it continued to move higher. And my plan at that point was to use a close below the prior day's low as a trailing stop loss.
But then it gapped up.
Yeah, so for about 2 weeks after, it looked excellent, a great strategy, and it looked like we were going to make even more out of the trade than what we had initially bargained on. But then overnight, we had Google results, which were disappointing. And of course, the share price gapped sharply lower. And this is what happens often in US stocks, I've noticed, is that you can get these enormous gaps, either lower or higher, when results surprise in one day, in one direction or the other. So in this case, Google's share price gapped significantly lower. See, it dropped about $100 per share on the open on that day in late April. And at the time, I said that we would just actually hang fire and see whether the share price manages to hold above that 1160 support zone, which was where our stop loss was. and if it was able to try and move up and try and recover some of that gap. Now, it hasn't happened that way. Unfortunately, what's happened is it's actually traded weaker, and it went down and it traded below our stop. So it triggered the stop at 1160, so that meant we sold out the remaining 5 shares at 1160, which meant on that half of the trade, we lost $144. So we made 133 on the first half, sorry, 233 on the first half of the trade, but we lost 144 on the remaining half, which means we came out with a small profit at the end of the day, but nothing to really get too excited about.
Yeah.
It is unfortunate, and it's one of those things, especially unfortunate given that it was actually really looking exceptionally good for us back in late April.
Yeah, well, if we all knew when to sell, we wouldn't be sitting here.
Well, exactly. That's what I always say. Knowing when to sell, I still think, is the hardest part of trading. So here's another example of that.
Garth, okay, last 3 minutes, we're going to talk about a stock that you're watching. It's Astral Foods. Why are you looking at this one?
Yeah, so Astral Foods is interesting, and the reason I say that it's interesting is there's a fundamental backing to this and a technical backing. So let's quickly talk about the fundamental story. Astral Foods, as you probably know, do chickens. They're a major chicken producer in poultry producer in South Africa. Now, related but unrelated is that there's a breakout of African swine flu in Asia, which has resulted in the culling of millions and millions of hogs, pigs, in the Asian region. I've read up to 70 million pigs that have had to be slaughtered because of this outbreak of African swine flu. Now, you might say to yourself, well, what is that going to have to do with chickens? The answer to that is that you may very well find now that there's a protein substitute away from pork into chicken or into poultry, because there's now obviously a whole lot less pork available, and in addition to which the pork price has gone absolutely through the roof. So based on those two factors, you are likely to find that the demand for poultry as a protein source begins to pick up.
Yeah, okay.
And so
a substitution effect.
Yeah, correct. And Astral, being a poultry producer, would benefit from a rise in poultry prices. So that's the background fundamentally. And this is not something that you can just suddenly fix overnight. I mean, this is likely to be a theme that could actually play out for quite some time. Now, in terms of the technicals on Astral, it's been forming this huge, big rounding base, sort of saucer base pattern over the last 6 months. The recent break here above 180 Rand per share is a bullish break. You'll notice how that clears all that overhead resistance. So that's quite a significant move. The share price pushed very aggressively higher to the 200-day moving average recently, and it now seems to be consolidating, and effectively it's pulling back towards this breakout area at 180. Now, to my mind, there's quite solid support down here at about 180, maybe 175, that sort of area. And if you're wanting to get on board for a medium-term trade here in Astral, I think this is a nice opportunity to do so. Okay. And this is what I'm going to be watching in the week ahead, potentially to put on a medium-term trade here. So it's not necessarily something we're going to look to enter and exit quickly. Yep. We would look to probably hold it for a while. And just quickly talking to the longer-term patterns on Astral, it's a very cyclical stock. Its earnings pattern is very, very cyclical. So what you find is that the share price has the tendency to rally 100%, 200%, and then pull back 50 or 60%. Yeah. And you can see over the years here, this is now going back over 7 years, you can see the significance of the swings in this share price. Now, it's very depressed at the moment. It's fallen all the way from nearly 350 Rand down to 150, so down by more than 50% over the last year, really. It's now beginning to look as if we might be starting to enter the next upward cycle potentially. Yeah, okay. A stock to watch, so a lot of aspects there. And then just very quickly to wrap up with Garth, portfolio, I suppose, has been chipped away at, unfortunately. It has. So our local portfolio has been chipped away at by the reduction in the price of cup. So we're only up 3.5% there. I mean, I must say at the half-year stage, I think this is probably one of our poorest performances year to date. But it is only halfway through. We have to hold out for the rest of the year. And then offshore, we're still down about 2% after that Google trade that also stopped out the remaining half of the trade there. Yeah, okay. Well, on that note, we leave it there. But there is the rest of the year to make things back. Garth, thanks as always for joining us. Garth McKenzie is, of course, founder and editor of Traders Corner.